When we value a residential property, regardless of if it's owner-occupier or invested with a tenant in there, we value it on a vacant possession.
Typically, the more you spend, the better valuation comes back because the cheaper one's got to do it faster and nastier.
Yeah. Residential is very different. You have no say. No say. The bank, it's like a Russian roulette type situation.
People say now, oh, interest rates are really high. They're not. They're just actually a normal kind of interest rate, maybe a little bit higher than average.
Bankers have great relationship with valuers. And as valuers, we're encouraged to have relationship with the banks that we work with. I've been hearing, Steve, since I started valuing, Parramatta's the geographical centre. It's a new CBD. It never has. And
Careful, I'm from Parramatta, right?
Right. I used to live in Bankstown.
Bankstown Grove.
It always comes down to a willing buyer and a willing seller.
Welcome to the Commercial Property Investing Explained series. I'm your host, Andrew Bean, and I'm here in studio again today with my co-host, Steve Palise. How are you, mate?
Good, man. Busy. It's getting into that busy time of the year, which is nice. What about you? Were we up to anything exciting?
Mate, not really too much exciting. Just
not
surviving.
E-foiling or
just surviving having kids. Just surviving having kids. But we've got a really special guest in the studio with us today, Belinda Valuer. Would you like to introduce her?
I think you just did. So.
Introduce what she does.
Belinda, I'm actually really excited about Belinda. She is like a big name in the industry. We've got a valuer in our team. And he was overly excited. He wanted to come here to meet you today, which is really cool. She's a residential and commercial valuer, but maybe I'll get you to explain exactly what you do.
Yeah, so I've been a certified practicing valuer for 20 years this year.
Oh, wow.
Yeah, I started valuing when I was 12.
I was trying to think of a joke there, but I'm like, this is a zone I probably shouldn't go in. Weight and age is the two things on the podcast we're not allowed to. Actually, a bit of housekeeping. You can't mention the word self-storage, all right?
Okay, storage self. Got it. We'll use it the other way around. Yeah, so I've been a valuer for 20 years. I haven't how people I used to do this and then I fell into it. It's like I literally just, this is all I know. Yeah. So I went from school to uni straight into valuing. Valuing is good. It exposes you to a lot. So it's not like you just do one thing. Also became a registered tax agent about 10, 11 years ago. And that just means I'm qualified to do tax depreciation schedules. So that comes in really handy because I do have that tax background and that valuation background. So it makes me sometimes sound a lot smarter than I am. So
Can I ask an unprofessional question?
Go.
I don't know many glamorous females who work in valuation. Is that a typical norm? I don't think most of the time it's 45, 50-year-old men that are slightly overweight that wear khakis.
True story. I used to knock on, I'd be excited, 20-something-year-old knocking on the door, suited up, because my mum always said, you got to look professional everywhere you go. I was like, got it. And they're like, okay. And I'd be like, hi, I'm here to do the valuation. And they're like, who else is with you? Are you on your own? Is it just you? And I'm like, you don't look like the type of person I thought you would. I'm like, what were you expecting? And we had this running joke on our, there was a book, Valuation 101. And the guy on it, I promise you, do you remember Harold Bishop from Neighbours?
Yeah, played the trombone.
Straight out. This guy was copy-paste Harold Bishop, and he had a clipboard and he had pens in his top pocket. And I was like, I reckon if I look like this guy, no one will question me. But no, I don't. Unfortunately, look like Harold Bishop.
Did you find that hard being young in a male-dominated industry? Was it a point of difference, or was it kind of you had to prove yourself? Because I came from mining, and the females I saw, female engineering interns, had a way tougher job than the guys.
If I can't say that it wasn't a little bit harder, but I don't know. I just I always grew up with boys. I had boy cousins. My brother, I had these boys that lived across the road, and
crazy
I was
Greek family probably.
They're Macedonian family. Yeah, same. And I played soccer. I was a bit of a tomboy, so I was always very comfortable. And I'm a bit of a girl's boy's boy. I never felt uncomfortable because I would just be like, hey, what are you working on? Can I help? And I think in that industry, they just respected that I feel like if you're a female and you're just really there to do the job and be respectful, they then respect you back.
Yeah.
So I did feel uncomfortable a couple of times going into homes alone if there was men in there. Yeah. As a female, that would be the only downfall of being a valuer. In terms of the workforce, no, I can't say. Okay, I work with very professional men all the time. we had a chat off air. Some other people I have worked with are very unprofessional, but in the valuation space, very professional. And then you go into people's homes. So that's a little bit, there's been situations where I'm like, I'm just gonna leave. I'm just gonna leave.
So why was it just valuation? You just love property, and that was a nice kind of segue to get into it?
Yeah, I always I don't know if your parents were the same. Mine just brainwashed me from a young age. You've got to go to uni. You've got to study. You've got to go to uni. So I've gone, I got to go to uni. And I liked real estate, but I didn't want to be a real estate agent.
Yeah.
And I kind of, I don't know, divine intervention. I opened up the book, the UAI book at the time, and it had property economics. And I was like, oh, yeah, what's that? Then jobs that you could get out of this course was valuing. And I was like, oh, I know a guy. Yeah. He's a valuer. Call him up. And he's like, yeah, Belle, it's good job. You should do it. Yeah. Rest is history.
Not going anywhere as well. So
yeah, no, I hope AI doesn't take over our jobs, but
it will, but it'll just change what you do.
Change.
It's the same as like for data for when we look at property. You used to have to go through magazines and get medium house price and stuff like that. It's just a tool that you'll use to think.
Yes.
You'll still need someone to go look at properties and kind of suss it out. So that's cool.
And manage the robots.
Yes. Yeah. You got to, as they say, like, don't hate the player, hate the game, or learn the rules and play the game properly.
It's like, so I'm a design engineer by trade, and I remember going into my first engineering job, the old blokes used to tease you being like, you don't even have to, like, it's like draftsman, like how to draw the stuff. And I'm like, yeah, but I can do it in a 3D model in 2 minutes. You spend 4 hours doing it. And they're like, no, you need the fundamental skills. They're all dinosaurs now. Like they're out. So it's just another tool that gets you there quicker.
Yeah, I've seen the meme, and it's like your teacher's like, you have to work out that mathematics equation. You're not going to walk around with a calculator in your back pocket, are you? And people pull out the iPhone and they're like, haha.
It just means like, I don't know what a typical value might do. I don't know, 5 a day if it's a simple residential. It might just get to the point where you can do 30 a day because you've got a tool to do them faster.
Yeah. Yeah, that's it. Work smarter, not harder.
100%. So speaking of valuations, today we're actually going to be having a chat about the difference in valuing commercial property versus residential property from a valuer's perspective. So that's why we have you here. So we just wanted to really get an understanding of, from your perspective, not an investor perspective, what's the actual difference when you're looking at commercial property versus residential valuations?
Yeah, so the biggest one that I don't know if most people are aware of, but when we value a residential property, regardless of if it's owner-occupier or invested with a tenant in there, we value it on a vacant possession, meaning that vacant in all manner of that word being vacant, no furniture, and also vacant, nobody's occupying that property. Because when you do sell a property and the bank possesses it, that's all the bank care about. What would we get for that property if it was vacant? And it also then, when you get homes that are beautifully furnished and they take the furniture back and you go, oh my God, what did I just buy? Yeah. We are technically trained to look past all that. Whereas, going back to that, a lease on a residential property is not registered on title the way it is on a commercial property, even though you are bound by the guidelines and the regulation in that lease contract. It is not registered on your title. So there's penalties, but you can get rid of that. When you have a commercial property, you value it subject to whatever lease is or is not in place. And that's the biggest difference when we're valuing. So as a residential property, as a commercial property, that property could have a lease in place, which then makes the biggest difference in terms of, what kind of rent, what terms, what conditions, what is that lease subject to. And we have to take that into consideration. And most of the time that lease is registered on title. So whenever we do find that we are researching sales evidence, sometimes we can pull up leases easily because they're on title and see how they compare to the subject property. So one vacant, one subject to the lease.
I think the commercial's more dynamic, obviously, because there's more factors at play. Like you said, the lease and who the tenant is and how long the lease is and the type and layout of the building can change. Whereas residential, I don't want to say it's one-dimensional, but like you said, it's got furniture or it doesn't have furniture. There's only the two cases. You do it for the non-furnished version.
Yes. And obviously you don't live in commercial property, so the main reason we have homes is to live in, whether you're an owner or a tenant. But with a commercial, subject, usually like we've got to take into consideration, like you said, the zoning, the lease, sometimes it's make good, sometimes it's the quality of the tenant, and it's, if there's multiple tenant mix. So it is definitely not one-dimensional commercial. And when we value it, you know, there's a lot of that we need to consider that you don't, absolutely not in residential. And also some residential property qualifies as commercial too for banks, even though it's not
on the zoning.
Yeah, and if it's got more than 3 or 4 areas of occupancy, mixed use, sometimes they have, a residential property, but it's got a commercial lease, like a doctor's surgery or something, and that can, and people don't realize, oh, that's a good buy, and then all of a sudden it just throws a little bit of a spanner.
I've often thought that's quite a good value add, is taking a residential property from a residential purpose and then transitioning it to a commercial property and then being able to force value that way. Do you see that a lot?
You do see it if it's like, it works better, I find, in kind of like the regions.
Yes.
Yeah.
Like Bathurst, things like that. There's a lot of them in Bathurst, actually, on the main street.
I find it works better there. In Sydney or major capital cities, a bit more black and white. You know, you get and I think it goes back to the existing use rights of that property. So if you have a home on a corner that's been used as a dentist surgery forever, then it's easier to continue and on-sell it as a dentist surgery, even though it might have a residential zoning, versus just having a regular house on a corner going, hey, I got a great idea. I'm going to turn this into a residential, into a dentistry, dentist office. So, in the regions, I think because their commercial CBD is not as prominent, I guess, as you find.
I get clients all the time. They're like, oh, I want to buy this residential house and we'll put a GP clinic in. They'll be worth way more. I'm like, that's not the issue. It's not the conversion. It's finding a GP that wants to use that house. Yeah. Most of the time they're going to buy one themselves. They're not going to do average Joe. Oh, let me rent your house off you. And I haven't actually met anyone who's done it successfully.
Yeah, it's very difficult, because when I was first starting like investing in commercial property, I was like, how can I do this with only like a 90% LVR? So I get a 90% LVR on a residential property and then turn it into a commercial, and then I don't have to have the 30% deposit and then get the cash flow. But it's hard to find properties that will literally to do that, and also you need to have a tenant ready to go.
There's better ones to do it, like suburban retail stuff, like my one. That's way easier to get a tenant. You advertise for a dentist or a GP or a pharmacy. That's way easier than converting a house. Yeah.
And another thing people don't realize is the fit out to convert it and to get it into like to a medical grade.
Oh, crazy.
Yeah, and sometimes the tenants might look for incentives in their lease to then compensate, because they're like, look, I'm going to be here for a long time, not a good time. So I'm looking to have, I want to set my practice up. I want 5-year lease or 10-year, whatever, right? And then they're like, I want some incentive to keep me in here. I'm giving you security with a 5-10 year lease, but it's not cheap to get me set up. So you can, yes, you're getting a long-term tenant and you've now got around the 90% LVR, but you're hit up front with potential incentives that you have to pay out.
We had a client who paid 50% of the fit-out costs for the doctor, which ended up being about $200,000. Like it was quite a lot of money, but I think you got a 7-year lease on it with a kind of guarantee. Because a lot of doctors, especially if they're just starting a surgery, they don't have the money to pay rent straight up front, fit it out, get business. That probably takes 3 to 6 months to start getting cash flow. Like they need some help sometimes.
Yeah.
It's actually quite interesting. So when you're doing a valuation, when there's been a large fit out, how do you factor that into the valuation, if at all?
Actually, let's take a step back. Let's just do the different ways to maybe value a commercial, and then we'll go into that one. Okay. So at least we get the different types.
Yeah, so I guess when we talk about different type valuing a commercial, because commercial is not like residential. It's not, residential, you've got house units, townhouse. Commercial is very different because you've got retail, commercial, strata, you've got office, you've got shopping centres, I guess, because you've got single retail, and then you've got industrial warehouses or a self-storage. I guess it depends on. The principles are all the same. It's all based on a capitalization rate. Yeah. That's how we value it, because you are buying the property per se, but you're buying the income that the property produces for you as an investor. You're buying the cash flow that property. And if the property is not at its not at its highest and best use, you're then buying the potential of that property. Therefore, it might not be the highest and best use for its zoning. It may not be highest and its best use for the location, and it may not be highest and best use for that tenant mix. So that could be what you're paying over and above that capitalization of the existing rent. But that principle pretty much runs through all class of property. So whether it's retail, it's just about comparing it and getting your evidence from like properties. But you can find, again, in regions or quite secluded areas, it's really hard to find.
Yeah, you mentioned something before the podcast about the valuation is not for the investor. And then we're talking about the difference between investor and owner-occupied. It's actually for the banks. And that's why we mentioned like my shopping centre where I got a short valuation because they didn't take into account the land component, which I did. And that's why I got a short valuation. But how do you do it if you've, say, got a vacant warehouse then? Because do you then just find the comparables for leases to work out the cap rate?
Yeah, you obviously have to take into consideration vacant, but you have to work out the rent and then that contingency period of finding that lease. And especially too, if you've got, even if you buy it or you're valuing a property and there is a lease in place, but the lease is coming to expire very, very soon, that tenant is not obligated to stay on. Right. And even though they've given you a verbal promise, unless that is signed document that a valuer can see, even though you're like, oh, trust me, he's my mate, he'll stay on. He's a great tenant, he's been there for years. Unless a valuer has it in writing on that day, you know, it's to say, yeah, he's going to stay on. We then say, okay, if as a buyer or as to the bank to lend money, we see this as a risk because this tenant could vacate, and then we've got to factor in 3 months of no rent, or 4 months. You kind of have to also analyze the market and see your vacancy rates and your vacancy factors that come into play when you don't have a tenant in there. Certain areas you'll find tenants very quickly. You have to make sure it's the right market for that property. You know, an example, the CBD office space vacancy rates are obviously not as high as COVID times, but we are seeing that it's still quite high. So if you have an office space that's vacant in the city, you're going to have to make it quite enticing for a tenant to come in otherwise. And it has to be taken into consideration, the vacancy rate and how long that period will last in your calculations. 100%. And working out.
One of the points I always say to like investors is you need to analyze the property better than a valuer, because you'll do it for the banks. You then have to do all that work, as well as the stuff like foot traffic analysis, like competition analysis, talk to your tenant to find out if they're staying on, etc. So you've got that layer plus more when you're buying an investor. You can rely, because the valuers will give you a lot of that information, but they're not calling the tenant necessarily and finding out what their plans are, how many other businesses do they have, what the foot traffic, what the issues are with the neighbours, how the air conditioner is going. So you got to do the valuation work plus all that other work if you're an investor. Yes.
And you got to remember, we are employed by the bank to give them basically a document that, and all commercial reports to banks have a SWOT analysis in it, and you've probably seen it, and that's the strength, weaknesses, opportunities, threats that property has, that subject property. So they're telling the bank the good, the bad, the ugly, everything to do with that property. And you as an investor might see a hell of a lot more opportunity that a valuer is like, I don't care, because it means nothing to the bank. They're not going to develop it down the track. They're not going to, do all these crazy ideas that you might have as an investor, because all they care about is almost like a worst case. And this goes for residential as well. It's like a worst case scenario. If I lend money and you then can't pay your mortgage and I take possession of that property, what am I going to get back? Because
that's why we have a lower LVR, because if they flog it for 30% cheaper, they get their money back.
So the bank don't care. They're not there to invest. They're just there to, it's a business transaction for them.
I guess you can't take it into account unless you have a DA, approved DA for some kind of development, right?
Stamped approved DA. Otherwise then it then becomes a hypothetical feasibility almost. And we just go off instructions from the bank. Completely off topic, I had someone just reach out today and say, hey, they're renovating a house. The house is in the middle of construction. They've ran out of money. And they're like, if I get the bank to value my home, how are they going to value it? And I said, it depends on the specific instruction the bank sends to the valuer. Honestly, as valuers, they say jump, we say how high.
Yeah.
So they'll say there's no lease in place. Hypothetically, what would it be worth fully leased? What's it worth as is? What's it worth? So they can run different scenarios to us. We've got to get it in writing. We've just got to make sure we understand. But sometimes you get, not all the time, but banks will give you hypotheticals that they want to run on their back end. I'm like, okay, that's why we're here.
This is specifically why I actually like to employ the valuer myself. So I actually get the valuation done and it's my valuation, right? And then we assign it to whatever bank we want to use. So I'm in control, because if like a bank actually instructs the valuer to do it and then that finance blows up, then I've got to get a whole new valuation done at very, very close to the settlement. So I like to control the valuation and I'll pay more to do that.
Well, maybe that's a good question, because typical what happens in the process when you buy an investment property, the bank will give you a panel of 3 different valuers and then you choose one. And that's where most investors are just like, I have no idea which one to choose. And it's normally a price range and one gets them slower, one gets there faster.
Yeah.
Don't want to say it, but typically the more you spend, the better valuation comes back, because the cheaper one's got to do it faster and nastier. But one of the other things I find is we go to the agent, we say, who do you want to work with? And then they'll sometimes be like, oh no, go this person. I know they'll give you a good valuation, because they know this sold, this sold. And they can actually get in your corner a little bit, being like, oh, I've got this one under contract. This one sold a month ago. Stuff that might not be on the system yet.
Yeah, and that's a good point. Residential is very different. You have no say. No say. The bank, it's like a Russian roulette type situation. But commercial, they do go. Bankers have great relationship with valuers. And as valuers, we're encouraged to have relationship with the banks that we work with, because we want the work as a valuer and they pay good fees. And you want to have that relationship where you can ask them questions. And also too, if you need a document, I just call my banker. He knows me. I'm like, dude, I need this document. And if you want this report tomorrow, I got it. So it's about having that relationship with your banker. And I know they can't always tell, they put it back on you, but they could also guide you as well. Your broker will obviously broker the deal, but the bank is the one that puts the finance together. So even though you have a great relationship with your broker, it's the banker for that bank that the money's coming out of. They're the ones that the valuer talks to, not your broker.
Yeah.
But this is why you want a good commercial savvy broker who has good relationships in the banks and they bounce off each other.
Yeah, and a lot of mortgage brokers will say, I do commercial. Yeah. And it's almost like, do the mistake and apologize later. You know that saying? I don't know how that right.
We almost talk about this every single podcast about like every broker will say yes to the work, but not all qualified. It's same as valuers, same as buyers agents. So
so they would. We see deals because they've got to then have specific language around how they package that deal to the bank. So then the bank will like, oh, okay, I can see, the risk on this client, the type of property that they're buying. And if a broker doesn't use the right language to then get that banker to then lend the money, it can really affect the deal.
I wasn't going to bring this up, but like valuers, like liability for the banks is huge. There's a lot of people get sued and stuff for getting incorrect valuation because the banks want to blame someone if there's an incorrect valuation.
Yeah, I've sat in front of a judge.
Oh, there you go. Okay.
Yeah. I've done close to 15. Look, it could be anywhere between 15 and 18,000 properties. Honestly, I don't know. 20 years, 5 a day as a valuer, commercial valuer. Wow. I haven't done commercial for a long time. So, but it's funny because I haven't done it in a long time and I haven't been a predominant commercial valuer, but you work as one, like you're working with, and just talking about, it's like riding a bike. It's all coming back, but you need to sort of be careful on, where you get your information from, because when I got sued, I sat in front of a judge that the mortgage broker sued. That's where you got LMI. That's where you got lender's mortgage insurance, because it's like you have a car accident. Yeah. You call up double AMI and RMA and you're like, hey, just had a prank, sweet, send through your details. They give you a check, you fix your car. Exact same thing with the bank. They call their broker up. They're like, hey, someone fell through. Cool, send us the documentation. Here's your money for the downfall. See you later. Westpac's on the happy days. Then the mortgage insurer's like, okay, now we need to get paid, right? And that's when the mortgage insurer chases the guy that hit you or the person that hit you to get the money back. you're sweet. You've been paid out. The lender's mortgage insurer, whoever it is, will go, right, who was involved in this deal? We've got a broker. The valuer. We like the valuer because they said to the bank it was worth this. The bank lent the money and they've obviously sold it for less, made a loss. We'll see you in court.
Yeah.
And that's where the Australian Property Institute, our governing body, have a thing called a limited liability. In our clause, that means that we could have contributed to it, but you can't pin the whole thing on us. We're limited.
It's such a volatile industry as well, like especially with commercial, like stuff 6 months ago, completely different price to now. So where you choose your line in the sand can change. And then who the tenant is, like it just changes so much.
Yeah.
Yeah.
Yeah. But if you ever read a valuation, I'm sure we all have here, there's lots of clauses and lots of, guarantees, like no guarantees
like
and stuff
pages.
like that. It's crazy how.
But like I said, that's not for the investor though.
Yeah.
They're trying to protect themselves for the bank as well. But
Yeah, and we are very specific about the language that the bank use and what the purpose of the value. Like any valuer you talk to, myself included, someone call me up, I need a valuation. The first question, I don't care the address, I don't care the purpose. I don't care the address or where it's located. What's the purpose of the val?
Yeah.
Okay, because if it's for stamp duty as opposed to mortgage, as opposed to family law, they're three very different documents.
I went through a divorce about 10 years ago now or 9 years ago, and I had to get a different valuation for my residential properties compared to the bank. I was just like, I'll get an appraisal. I'll go talk to the banks. No, there's a family law like bank valuation. What was the name of it? It's got a certain name for basically if it's going through a divorce.
Yeah, there's you have to get an affidavit. You have to sign. You got to put your CV. It's about a 30 to 40 page document.
They're more expensive as well. I'm why are these different prices? It's the same job.
Yeah. We also got to we also quote a lot because this is going to get scrutinized to the eyeballs. So your T's are crossed, your I's are dotted. And also it can be scrutinized in court because say your partner got her own one and she then, that value's conflicting and then they'll just get ripped apart by an expert.
Especially for someone like me who works in the real estate thing, I that's why I had to get it. It had to be completely third party because I know so many agents and valuers and that I've got a sway. So I had to solicitor, you organise this. I have nothing to do with it.
I've had clients call me directly, and I'm like, "What's the purpose?" They're like, "Oh, family law." I'm like, I'm contaminated now. It has to come from your lawyer because you've directly approached me, and it's not seen as independent and unbiased and objective. So I'm like, that's a good fee.
When my valuer says that, I say to make the most money. That's what my answer to that.
But you can shop around for commercial values. You can't shop 100%. Around for residential.
Yours is special, self-storage is a specialist job as well because it's different. You only had, 2 or 3 people you could choose, wasn't it?
There's probably about 5 really good self-storage valuers in Australia. And they actually come from the Self-Storage Association. So they need to be aligned with this association and we want to get a good valuation. So, and you can't really have industrial commercial valuer coming in an industry specific asset. You really need someone who knows what they're doing and understands the value of the business as well.
And that's a good point. Valuers in the commercial space are very pigeonholed, and that's why I don't practice every day. It's not my everyday commercial because I think if you're going to do it good and specialize. Like if you're a shopping center valuer, you're a shop, if you're, we've got valuers that do service stations, childcare centers, goodwill, going concern valuers. So plant and machinery valuers, and that's kind of all they do. So if you're going to someone and you're like, we do everything. It's like, do you though? You'd want to make sure that that's why I think that's why you got to make sure that they're qualified and really experienced. And that's why I think if you're ever getting a commercial property, it is good to go to the really big firms because they have a lot of valuers that are very, very niche and experienced in that space, where the smaller guys have less valuers, which is fine. But if you really want to get that expertise, go to the big companies, the big ones. I've worked for 2 out of the 4. I guess it's like the banks. I've worked for 2 out of the 4, and I would recommend them in a heartbeat because I know that that's all they do.
Yeah, typically the bigger ones are more expensive, but you get the best valuation. That's a general rule of thumb for most investors. If you go one of the cheaper ones, be ready for a rough and ready one.
Yes. Yeah.
Experience matters big time, especially, I mean, you can actually probably go for a smaller one if they're only doing that specific niche asset. You know, that's the only time.
Yeah.
It's everything. Buyers agents, mortgage brokers, valuers, insurance brokers.
Yeah.
It's experience is everything.
The riches are in the niches. So
Yeah. Yeah. I've just always enjoyed residential more, and I've always stuck to that asset class. But, you know, there's been times where I'm like, I can't necessarily do the report for you because I have people that do it. But we bounce off each other, valuers all the time. I get valuers calling me up. I call up. It's a small industry, and they're very generous with their information. I think you can see now I don't shut up. But you get a valuer on the phone and you talk to them respectfully, like you don't kind of passive aggressive go, this figure's crap and you don't know anything. They'll like go back into their shell. They won't give you anything. But if you kind of stroke their ego a bit, that was a great report, I just want to have a chat, they won't shut. Like you can get so much free information out of a good valuer if you're smart.
Yeah, 100%.
I'll give it a bit of a side question. You correct me if I'm wrong, but I rarely meet successful investor valuers.
Yeah, no.
Similar to like accountants. Accountants should be really good at numbers.
Yeah.
Rarely meet successful investors that are accountants. So because there's more to that. Is that just because you guys are risk adverse because you see the horror stories, or too conservative?
Yes, and it's funny that you use the word accountants. I reckon valuers are just a glitch in the matrix where they just picked valuing instead of accounting because like, and then you said that, you know,
sort of the same thing, but just different.
Yeah. Like going back about me being a little bit like not a typical valuer, valuers are very sensible. I mean, Friday night drinks, if you know. But Monday to Friday, man, we are so boring. Like if you hear conversations in the office, you're like, oh my God, get me out of here. Like we are like so nerdy. It's like the nerdy of the nerds. Yeah. Like, you know, the nerds at school, if they didn't become an accountant, they became a valuer. I'm telling you now. So yeah, they definitely.
We've got a name for the podcast. Why valuers are nerds?
We are nerds. I'm an undercover nerd. Like you can't shut me up. But they aren't the most exciting.
That's right. I'm a self-proclaimed property nerd as well. So Steve calls himself an expert. I call myself a nerd. So.
They're not. They're just accountants, but with number. And I think because they're not risk takers, they are risk protectors. Like they protect the banks and they protect. Like I found it really hard to value my own properties.
Sure.
I was like, it's worth a lot more. It's like typical. Yeah, it's worth heaps more. I put my estimate, came back a lot less. I'm like, what an idiot. And then I go, I want a copy of the report. And then I saw the copy of the report. I was like, okay, yeah, fair enough. So I read through sales and his comment. I was like, yeah, okay, I see where you're coming from.
Yeah.
Whatever. But a lot of people don't know how to read a report. Yeah. Like they honestly, they don't. Even some commercial reports are very, very complex. Like I'm like, skim over just, and even the numbers bit, a lot of people don't understand.
Most don't. I find most people, we open a valuation, we literally scroll through to the page that has an appraisal price. Yeah, that's the number I care about. And the only time you care about the number is when it's less than you thought it was. Then you go back, what comparables are they using for this?
Yeah.
Oh, that one's a piece of SHIT. Like that shouldn't be comparing. You start criticizing. We've also had some bad valuations where we get the report and it says it's in a flood zone. And then we're like, it's not in a flood zone, go on the council maps. And we go back and like, oh, sorry, that was from the last report. We've got to take it out. I'm like, did you consider it or did you not consider it? And then the price stayed the same. I'm like, how is this the same price?
Yeah.
But again, that's just the cheaper companies just churn and burn, get them in, get them out.
They usually work off the old report and they don't take a new template. But it's funny you say that because we've it's very hard to get a valuation changed as well.
Yeah. Well, we found that they didn't change the number. They just deleted it off the new report, and I was just like, how is this not taking an impact? Like,
it's because of insurance.
Yeah.
Imagine you had a valuer and they're like, oh, sorry, Steve, my bad.
Yeah. You're also admitting fault. Yeah.
Yes.
Yeah.
And then that becomes a mortgagee in possession situation. Yeah. And then you're sitting in front of a judge and then the judge is like, oh, I have two valuations here in front of me. So which one is it?
From 20 minutes apart.
Yeah. Is it the 2.1 with the flood zone or is it the $2 million without the flood zone because which one, like you weren't sure about this one. Are you sure about this one? You'll get crucified.
You just got to destroy all the evidence of the first one, then you're good.
Oh, there's...
Not so easy once you've sent it to a buyer's agent, not so easy.
I'm probably never going to get employed after this, but there has been situations where I'm like, you never received that report, right? Because I need you to get rid of that and I'll send you. But once it goes through, anybody that's a broker watching this, if it goes through your like a Valex system or a Velocity system, they're the ones that...
Oh, you don't want that,
If it goes through that, it's like digital footprint everywhere. You can't scrub it.
This is why I employ my own valuer, because I actually have had conversations with the valuer after they've done the draft report and said, did you take this into consideration? It's really good what you've done, but like, did you take this into consideration and stuff like that? Because like there are expenses that are not really there that it was charging. And I actually have successfully had a valuation increased just purely from having that one-on-one conversation saying, hey, like, like, it's a little bit different now. Maybe back then when there was no technology, this is how it would be managed with these expenses. But now I've got this technology and it's saving me $60,000 a year.
It's funny you mentioned outgoings. That's probably the only time you can successfully question and get a valuation change is if you're like, sorry, my bad. I actually have some extra outgoings that you didn't consider, or I gave you the old lease. These are the new terms of the new lease that has something that's not favorable. And then they base, and so in the report, they will have this as an amendment to the valuation released on this date, subject to new evidence being provided, such as blah, blah, blah. Yeah. And then they will state that. You'll never get a valuer that just like, don't, for bank, for purpose. I'm talking about like someone just needs a valuation. I'm like, you didn't get that one. But if it's a legal document, you have to then state in that report that this is then, whatever, it's been retracted, this is replaced. On page 7, we said this, it's now been replaced with this, and we've taken that, and based off that, this is why. And that's how you can kind of save yourself if you had to. But just going to a valuer and saying, hey, man, you're shit, change your valuation. But if you go to a valuer and you're like, hey, I saw in your, you said this was a net yield, it's actually a gross yield, or this was without gross rent, this is a net rent and you didn't calculate it properly and blah, blah. Like if you go with them with actual evidence, you have more of an opportunity to say, because you thought it was gross, it's actually net. It then changes the that's now a net yield. Is that you capitalize this on a gross yield? Like,
it's still so hard though. They rarely change it.
But if you have to go with actual evidence, like for a reason, not just... Yeah.
We had one a few weeks ago where it came in, I think it was about $100,000 short because there was a $30,000 maintenance bill last year. But then we're like, look, the last 5 years, there was no maintenance. It was just this 1 year, but they took last year's one. It ended up being a good outcome because we actually met halfway. So we got a short valuation. The seller gave us $50,000 off. So I was like, this is actually a good outcome for you. Just like zip it. Like if it came on point, we wouldn't have got that $50,000. But it's so hard to get them to change the valuation.
Yeah. So you almost like just try to get everything and having that conversation with your banker, going back to that and saying you might think this is a high price, but I want to justify why I paid this. Make sure the valuer knows. I want them, meet the valuer on site, explain to them, you're the investor, so you've done your numbers and are completely, like you use the other side of the brain, So go to the valuer, explain to them. People that are scared to talk to us on site, they're like, do we say something? Do we not? Yes. Tell them, talk to them.
Yeah.
They don't want to talk to you, but you force yourself to.
One of the points that I find is because like we normally buy stuff under a finance clause, and the valuation always comes in like a day or two before. And if it is short, you really press for time. You either got to go back and ask for an extension or try to just make a decision then and then. And that's where it gets really tricky for some investors. Yeah.
And that's okay if you're an investor and you see value in it, that you're like, and I think it's about being honest with yourself and going, I see, like, you always get people like, they're going to, the airports always come, always. The airport's going to make the values go up. The airport's going to make the rents increase. The airport's going to have extra traffic. Like, It's a hypothetical assumption, and
Yeah.
it's really hard for a valuer to go, this has been coming for 30 years.
You're not allowed to predict the future, though.
can't,
Your job is to
yes.
predict this moment in time.
Correct.
Like,
And if you know that you have paid a little premium on the assumption that, this area's going to get rezoned.
Yeah.
And sometimes rezoning doesn't always reflect extra value.
Yeah.
Because you need to maybe amalgamate a couple of properties, but in isolation, your property's not worth anything, even with the zoning.
When it comes down to the end of the day, if the bank can't securitize it, you can't bank on it for it to
Correct.
actually be happening and adding value.
Yeah.
So it's quite interesting.
Most of the time that is wrong. Like the common one we get in Brisbane, people go, Olympics are coming to Brisbane. We're going to buy
That's
that.
another one.
They
Yeah,
love
and
the
I go,
Olympics.
cool, what happened to Sydney in 2000? I'm like, didn't grow to 2012. They're like, oh yeah. And I live in Parramatta, so I went to Sydney Olympic Park after the Olympics. It was ghost town.
Yes.
It's great for long term because they build houses, infrastructure, transport.
And short-term
But
economics. Yeah.
there's vacancies go through the roof after Olympics.
Yeah.
So you're only getting a sentiment change in value, not a real life change in value.
And Parramatta's another one. I've been hearing, Steve, since I started valuing, Parramatta's the geographical centre. It's a new CBD, and it never has. And
Careful,
I
I'm
think,
from Parramatta, right?
right. I used to live
We're in
I used to live in Bankstown. Double 2 double O.
That was your Forester, Subaru lowered Forester out the front, wasn't it?
No, but I used to have
car I used to drive. I used to drive a
have a
Turbo Forester.
Suzuki. I used to have a Suzuki Vitara soft top.
With the dice.
Yeah. With the cross, the cross on the
Oh,
beads.
yeah.
It was manual too. So first time my husband jumped in, he's like, you tried manual? I was like, from Bankstown. I lived there for a short period of time, but it never left me.
Did you have an exhaust?
No, actually, I had a Hyundai Excel.
Weird exhaust.
my dad put an exhaust on it, believe it or
wow.
not. Yeah,
I
and
can
he
top
went
this.
to.
My car was
let's go.
a Daihatsu Charade with a Canon exhaust and,
Oh my God.
and chrome hubcaps.
Did you have a subwoofer in the boot?
I did. And then my next car
We
was
were being friends. I can see why we're getting along. Yeah, it's
I only
great.
got rid of it when I was age 30. I picked up my now fiance, and she's like, "What are you driving?" Like lowered car scraping on the ground. Like, I'll grow out of this at some
It's a
point.
Parramatta thing. You
And
get
were
it.
you one of these guys that had the CD tape deck, and you used to take the front off the tape
Oh,
deck,
yeah.
Oh, yeah,
and you'd
yeah,
see
yeah.
the guys at the pub or at
Yeah.
the shop, and it'd have the actual
Yeah.
front of their
Yep,
stereo with you,
100%.
so no one would steal it.
Spent $200 on that. And then the funny thing is, I have all my burnt CDs because I didn't want to pay for real ones.
Yeah. I sent a meme to a friend of mine, and it was like, I'm this old, and it was somebody using a club lock. And I was
Oh
like,
yeah.
Yes.
My dad still.
Crooks lock.
My dad still has a Toyota Corolla with like 50,000 kilometers up with the club lock in the car,
Yeah.
and it's just like, why are we locking this car?
Because those old cars are worth a lot of money
They
now.
actually are, yeah.
Crazy. Like my brother and my husband, when they get together, like, oh, so-and-so car, did you see what it sold for? And it's like 90 grand. And it's like these cars, anyway, it's like real estate. It's like anything. Hey, it just goes up if it's like old enough and been around long enough.
I had a Toyota Celica 1977 one, so old, cool, fastback one, and I bought it for like $1,500. Now I look on car sales, they're like 80, 90 grand. I'm
Yes.
like, should have held that.
I should have held
Good
that.
investment.
Yeah. So, what were we talking about?
So getting back to valuation, one of the things that I've actually been thinking in the back of my mind.
The CBD Parramatta. That's
Oh, yeah,
really good.
that's
Sorry.
CBD.
yeah.
Anyway.
Sick Parramatta.
Okay,
Yeah.
cut.
It's all
And
good. It's all good. So one of the things I've actually been in the back of my mind is when you're valuing a residential property compared to when you're valuing a block of residential units.
Oh, yes.
If the residential units has more than 4 units, it's a commercial
Some lenders
loan.
3, I believe, isn't it?
Yes.
Yeah.
Yep.
So, and when do you change to using a capitalization rate for that asset as opposed to a residential property where you just use a normal comparable kind of sales?
You still use comparables.
Mm-hmm.
It's you use a double or 2 methodology. It's almost like a 3 methodology
Yeah.
because it could also have under its highest and best use. It could also be, you can have a red brick 3-level walk up in Ashfield, Drummoyne that has the potential to be a mid-rise development site. So again, depending on the instruction from the bank onto how they want it valued, it can really depend because if they're like, look, they're wanting to borrow funds to develop on this, can we have a valuation on a hypothetical? I have done vows back in the day where I didn't have plans. There was nothing approved. Everything was done hypothetically. You can imagine super conservative because I'm basing everything off like the worst case scenario I've got nothing stamped from the councils. I've got plans, but they could be denied or could be years before it's approved. And they came back and they absolutely annihilated me. You've undervalued. I was like, stamp them, approve them, and bring them back. Then we can talk.
I've never really thought about it because like all the like apartment blocks I used to look at were 3, 4, 5, 6, 7. I just assumed you went, price of one apartment times how many there are, minus a little factor. But I imagine that changed. And basically I thought it changed the loan, not the actual valuation. But I imagine if you're buying a 50 apartment block, that's completely different because it's not individual prices times how many there are.
Yeah, it kind of like if you're in Des Moines and the rents, apartments, sometimes the land value is worth more than the capitalization of that asset for the income. So, for instance, you could have an apartment block in Des Moines that's like the rent and the value are kind of the same as one sort of like in Ashfield or Marrickville, for Darwich Hill, because there's heaps that pop up there. The land's going to be a hell of a lot more valuable in Des Moines. So you do also have direct comparables in that sense, as well as a highest and best use analysis, as well as like a not a feasibility, a summation where we go, okay, if we were to rebuild this and minus a little bit of depreciation plus the land to get sort of the land value and work on it that way. But there's different methods that when it comes to apartment buildings, but definitely the capitalization approach is one. Yep. Definitely adding all the units together, minusing off a bit of contingent, because then you kind of work out this can be easily subdivided into strata. So what does that look like? And work on it that way. So there are different methodologies. And then obviously whatever the valuer adopts, they've just got to put in their commentary at the back to say, we've adopted this methodology because it's best representative of the market value. Because if we do a capitalization approach, your yield will be really, really low. It'll be like 3.5%, 4% on like a gross yield, where that's silly. Like, why would you buy an asset of that, for a 3, but you've got the potential.
The same thing happens with like industrial sheds. You can buy like a really big block with a tin shed on it and it might have a 7-8% net yield, but the value is actually in the land because they know at some point you're going to knock that down, build a concrete tilt-up panel one. It's funny you mentioned like those areas. I have the same thing. I live in the Northern Beaches. Old house on land sells exactly the same for a vacant lot. Because they know people are going to knock it. They'll pay the $50,000, knock it down, and build their mansion on top. Which is kind of funny because you're looking like, why would I buy the land when I can get a house? But you don't want the old house there because it's beachfront. Yeah,
it's funny you say that because this is, and you guys must get it a lot too. Recently, the land tax has come out, and everyone's like, "Oh, they valued my land too high. I want to object." And I've had a couple of people say, Belle, can you have a look at this for me? And I've been a land value objection valuer because you get contracts for the Value General's office and I do land value objection. So you as the owner can object and get an independent valuation, but then the VG's office will get their own independent valuers to do an assessment. So like you've just spent money on a report and they don't care. They'll do their own assessment on it anyway. And when you have an established area, there's obviously no like Parramatta, but Northern Beaches, there's no vacant blocks, like plenty. You might have the one unicorn that's like, vacant block, but you do vacant land on homes that have been bought to be knocked down. Even though there's a house on it, it's not why it's not its highest and best use is not because it's underutilized. Correct. Thank you.
This is going to sound arrogant, but I jokingly, when people complain about their land value going up in value, I'm like, isn't that why we bought this property? Don't we want it to be worth more? Like, I'd be worried if it was going the other way.
Unless it's within 10%, don't bother. Like, and if it's they go, oh, but it jumped up so much from the year before, and I'm like, but maybe the year before was low. Because they do take an average. So I would say, if it's more than 10%, don't bother. But if you can find some sales, commercial's harder because it's hard to get vacant land sales and analyze it back to a land value basis. Really difficult. So, unless you're really, really certain, it's very hard.
There's just too many variables with commercial, like amount of the site they're using, age of the building, foot traffic, bypasses, what competition's in the area. Like it just gets nuts really quick.
And I think as an investor, they, even having, like I said, even if you do get an independent valuation before you buy it or use your guy, and just having it, valuers are so full of knowledge, and they're full of like, an agent will kind of fluff things up a little bit. A valuer doesn't care about the fluff. Yeah. Remember, we're nerds. We love facts. We love figures. So if you really want to get some information out of a valuer, just start up a conversation. They'll just they'll just come out. So they're a really good resource to use, especially if you are buying interstate, and you do have a buyer's agent. You're like, I just want to call someone. Don't call a local agent. Call them, but call a local valuer. That's their bread and butter.
That was going to be my question.
Such a good investment for people.
Where I find valuers in short is when it's like not an interstate, but someone out of area. So it'll be like a Brisbane valuer valuing a commercial in Toowoomba. You're just like, they've got no idea about Toowoomba. You want the guy who values Toowoomba all day, every day. It's a completely different market.
Yeah, and if it's a commercial, like a retail, you'd want a retail valuer, even more specific. But there's, and it just definitely plays, again, go to the big companies, have a chat to the valuer. If you're not, sometimes the people don't want to use buyer's agent. I think they feel they can buy it themselves. It's commercial is residential. I honestly, some of those residential buyers, I'm like buyer's agents, and I'm very vocal about this. If you line them up, I'll knock down 7 and keep you 3. Yeah. Honestly, they're not worth, they're just there to sell or get the transaction. They kind of buy what they think they should buy. But commercial, I think you knock down 3 and keep 7 because you need that guidance on that help.
Yeah, we give away all our content for free, like the commercial course and books and stuff like that, because we actually just show how complicated it is, and then people see the value in using us because they're like, okay, there's a 70-page due diligence report I need to do. Probably don't have time to do this.
I did your course.
Did you really?
Yes.
Oh, thank you.
Yes, and I'd like to say I read the books, but I did have a thorough flick through. Yeah, because I feel like
only
because I'm a valuer and I've got it, and I flicked through and I thought, if there is anybody listening to this and you haven't already, it's like I got a valuer tick of approval, and I do say that genuinely because I was like, even I learned some stuff, or just reiterate. You know what I did? I don't know if this is allowed. The costs are going to come out, but I put it on my dash and I just had it, and I drove to the Central Coast and back, and then I drove to Wollongong and back, and then the next week after I drove so I did 3 long car trips, and I just had it kind of like running in the background.
Oh, cool.
Yeah, so there was some stuff you pulled up about figures, and I was like, I can't look and drive at the same time, but that was like it, like in a really nice way. It like helped pass the time.
You were listening to it? You weren't reading it while you were driving? Is that what you're saying? Or?
No, the course.
You were listening to the course. I thought you meant like put the book on the dash and like you're like driving and like reading it like.
No, I'm not that bang. I'm not that gangsta down. That's a real gangster. No.
The course is good because you can download all the resource. But our first 10 episodes of the podcast series, we actually sat there with the book, going through like leases. Cool. We're going to do an episode on leasing.
Yeah, nice.
So that was for the people like you that just want to drive and do all that.
It is the best thing. Like if you do the course, it's just listening to it and you just get so much information. And that is stuff that if you want to go back and go, I want to listen to that, or because you had some spreadsheets, go back to it. Absolutely.
Oh, thank you.
It's funny what you said about residential buyers agencies, because you don't actually know if they've done a good job until like 5-7 years down the track, when you see that value increase. But with commercial, it has to be a good deal on day one. Correct. Because it has to get valued, it has to get accepted by the bank, and it'll be cash flowing on day one. So already.
And the other thing too, the residential, sorry Steve, is the last 5 years. It's only gone up.
This is exactly what I was going to say. The market's been too kind.
You could have got a dart and threw it anywhere in the country. And your property, you could have been my son, for instance. I could have gone, hey, Donovan, how about you throw that on the board, Mama, and wherever it lands, I will buy a property there. Let's go. And then I would look like my son's a property, like he's 8, by the way, but he would look like the smartest anybody could. And I think it's given a lot of people a sense of false, exactly what you said about the sense of false reassurance and that kind of safety net of, the property is only going up. And it is. This year, I think we are going to see it. But between the year 2000 and 2012, market did nothing. Yeah. So I'm not saying history will repeat itself, but at some point you've got to go, we need skill and not luck, and not just anybody going, well, look what we bought for our client and they made 70. And I was like, well, everybody made 70 grand the last 3 years.
You
mate.
literally could have bought any of the 50 largest cities of Australia and you've done okay.
Yes.
And literally, if you started investing less than 10 years ago, you'd never seen interest rates higher than like a 3.
Yeah.
You know what I mean? So people like say now, like, oh, interest rates are really high. They're not. They're just actually a normal kind of interest rate, maybe a little bit higher than average. But on average, we're usually at like a 4 or 5% cash rate. Yeah. So this is kind of like pretty much the norm, what we would usually see.
I get a little nervous when people are like, oh, the rate's going to go down 5 times this year. And I was like, please don't.
That's a lot.
I was like, please don't, because I'm just worried. It's almost like an aeroplane coming into land. And then and they're like, abort, and it comes back. That's what I'm worried about. Inflation, or the market is going to take off. And then if it goes up, it's going to be a hell of a lot harder to bring it back down again. I think that the RBA know that. And I think a lot of people are just, they understand things on the surface, and they don't really understand how the macro and the microeconomic of things work.
I don't even think they understand on the surface. We had so many clients that come to us and
Steve's like, they don't even understand the surface.
2-3 years ago, they'll come to us and be like, oh yeah, we're going to see interest rates high next year, and then they're going to come down a year or two later. And you're like, cool, why is that? And they're like, well, I don't know. I'm a mechanic. I heard some guy say, I'm just like, you got no idea. Like, we're in this game and I don't even understand it. Like, I've got 99.5 in high school. I'm good at mathematics.
Yes.
I don't understand it. I'm not playing the game for the next year or two. And when people say, oh, they're going to come down, prices will go up, I go, well, why were they going up in the first place? Well, I don't know. Cool. Why are they going down? I don't know. I'm like, cool, let's just stop talking about it.
The RBA don't even know what's going to happen.
They don't know.
They got to make a decision based on the information at the time.
Yeah. For me personally, I can't see it coming down because the market would just go nuts, and they need to stop that. Otherwise, we're in a bubble. But again, if you're buying this for longer than 3 or 4 years, what happens next month should not make a difference. And I actually quite hate them. And you've probably done this, and I've done this as well, where you talk about the rate changes. It doesn't matter. Like, why? Because so many investors talk around when they change the rates. Like, oh, this is going to happen. I'm not buying a property for a month. Like, I'm buying it for 10 years.
But they talk about it because they want their clients to think that they know what they're talking about, and like, oh, I know where to buy. Or if you want to know the next 10 hot spots to invest, download my free. And then it's like a honey trap to get your
there are 3 locations that are going to boom in 2025. You know what I'm
I know the guy. If you watch the property YouTube stuff, you know that person we're talking about. There are only 3 locations that are going to boom in the next 6 months.
Australia, New Zealand, Fiji.
I actually call him Property Boom Guy. That's how I actually know his name. He's just Property Boom Guy.
I actually know his name.
So I think it definitely is going to, as they say, the men from the boys, the girls from the women, or whatever, the
women from the valuers.
So I think, and it's important to have a science behind, even if where you invested didn't increase as much as somebody in another area did. Like, they might have got a year-on-year 12% and you might have only got a 7%. It's like, just wait. This is a long game. This is a long-term game. You've got in a great area, you've got a great asset. Just give it a chance, because the fundamentals are there, and long term it will perform. I have every confidence that it will increase. They might, and we see this a lot, and regions are performing very well at the moment across the board, all class of property. And we do find with the regions that they do go up a lot more. Sometimes they outperform the capitals, and when they come down further, and they stay subdued for a lot longer. So you hear people, I invested in Tamworth and it's done 15%. You're like, shit, I bought property in Sydney in a great area and it did like 8%. It's like, just wait. Just, when you're buying a great asset in a great location, don't get caught up, because what's hot today, with the hot spots, it's hot. It's going to cool. But if, I'd rather see a simmer for long term.
It's even more so for commercial, because there's other dangers. Like, one of my last employees, like, they used to buy very regional properties for like industrial with high vacancy rates, but they'd be like, oh, we got a 7% net yield, whereas we're known as like the boring investors that just get like good tenant, good location, tight vacancy rate.
Correct.
We were buying at 6%. 3 years on, where our yields just from rental increases is like 7.5%. That's still at a 7%, but
Yes.
they've also got a higher vacancy period and they've not had capital growth. So our return on investment is literally threefold just
Yes.
by buying a boring asset.
Yeah. Even if the rents, the cap rate stayed the same, if they have more vacancy, when you average out, they don't have as much money in their pocket per se because they've had these, and you've got to remember tenants coming and going and vacancies, expenses make good. There's, agent fees, there's reletting fees, there's all sorts of stuff that kind of, I'm sitting at 7.5%, but like it was vacant for a long time and you had to, you're still paying your outgoings during that time. It doesn't stop where you're sitting pretty for not as strong, but it's still more consistent.
But long term, it performs better anyway because the capital growth plus the rental increases plus the lack of vacancy, your ROI is literally 5 times as good. So it's quality always performs. Same as residential.
Absolutely. So anybody listening, it really isn't about chasing hotspots right now. We all saw what happened I just have to mention the word Perth. Yeah. Perth was more expensive than Sydney. And then it did not. When I say it did nothing, it did it's not like it was like it might as well call it Lazarus, man. This thing erected from the dead after like 12 years
it's crazy.
of nothing. Like at least Sydney, when it was flat, it was like beep beep. And like, is it a lie? Yes, it's barely like get it to the hospital, but this was gone, and now it's like it's made up for lost time. But imagine you sold just before the peak, or you bought just before the peak. You look like a genius buying now, but long term, is this sustainable? And that's what I think a lot of people got to, where you just slow and steady because you got the right fundamentals. Yeah,
I am very interested in to see how Perth will go now that we're in a bit of a different climate. We're working from home and things like that, and things have changed. How it actually goes when there is a mining downturn, because it's still uncharted waters now, seeing it go from booming to like downturn mining wise, now that the whole kind of socio way we do things has changed.
There's also a bit of a false floor from buyers agents because they're just pumping 50 investors, each buyers agent into Perth. That gives you a false economy as well.
It does. There's we had a Kapara day. So anybody it's a great day the API put on, and they have really good, I emceed it last year.
Just so you know, our course is credit points for API for your CPD.
Yes. So anyone that's tuned in to see what the hell I was talking about, hopefully I did you proud. But if you do the course, it is, did you say 10?
9 or 10, yeah. Actually, no, I think it's 10, yeah.
Yeah, like that's a big chunk. I'm going to claim that, by the way, because, I think I've got like one more module. Because I did do the quizzes at the end.
Yeah. No, you need the certificate. You actually have to get the certificate.
Yeah, but I was driving, so I was like, fuck, how am I going to get this? So at Kapara Day, they had really good speakers in there, and they were all, they do around Australia, a retail, commercial, industrial recap of each state. The CBD retail strip, like their equivalent of Pitt Street Mall, had the highest vacancies, than anywhere in the country. Yeah. Their vacancy rate for office was, again, one of the highest. Melbourne, obviously Melbourne's got problems, right? Like commercial, we'll just, it's I feel like they're our cousins down there. It's like, hang in there. They'll come around. But Perth, and I thought, geez, isn't that interesting? Because I don't have my finger on the pulse in other states for this type of data. And I just thought, isn't that interesting that the residential space is booming, but you think people still got to shop, the economy's still got to, money's still got to get injected in the economy. And if people aren't seeing value to open up shops in like our Pitt Street Mall, I don't know if you've been there recently, pumping.
Yeah.
Pumping. Like you can't, I think it was one of the most expensive rate per square meters of retail leasing in the world, our Pitt Street Mall. It was definitely up there. To say that like companies don't see value in opening up shops in their equivalent to Pitt Street Mall to get people to come and spend, does that make sense? It was quite correct.
It's actually been like that a long time. So when I used to work in mining, I used to go over for a month at a time and stay in the city because I was the young guy. I was like, let's go stay in the city. Not even joking, at 5:30 p.m, you'd walk out the office door in the middle of the CBD, ghost town.
Yes.
Like every shop closed. There's no one out. You had to go to like the hip areas. You had to go to like Subiaco, which I heard is a bit dead as well.
Yep.
But the CBD was just non-existent. I was just like, this is weird.
Yeah. And I think what people need to understand is this is why Sydney and Melbourne, so I'm saying don't worry about Melbourne, they'll get up. If you've heard me say this before, sorry, but I always say it, you got Sydney and Melbourne are like the two big brothers of the country. Like Sydney's the firstborn, everyone's so proud of Sydney. And then you got Melbourne is like the other big brother. It's like the two, like if you follow rugby, like the Burgess brothers, like, like the Hemsworth brothers.
You are from Sydney's West.
So you got the Hemsworth brothers, right? Like the two brothers. Yeah. And then you've got Brisbane that was like the little brother that's like, can I come and play? Like, you're cute, but not yet. Brisbane's grown up. And when you get that brother or that cousin that you're like, when the hell you had a girlfriend? Like, when did you grow up? That's Brisbane. It's come up.
You've got a child, Toowoomba?
Yeah, what? So I think what we need to take away from that is it's the money. It's the CBD. It is that sort of top end money that circulates, that comes out of a city that then filters and bleeds through the rest of the city, right? Sydney will never have that CBD taken away from it, never have that money machine that's coming out of our city, as well as Melbourne. Give Melbourne a chance. It'll come through. It's just hurting at the moment. Brisbane is really starting to, diversify and wake up. It's got a lot of Sydney and Melbourne that are like, guys, what are you doing? This is how it needs to be done. Perth doesn't have that. So if you don't have a city with a strong economic backing, because that's where money, the more you earn, the more you can borrow. The more you can borrow, the more you pay. The more you pay, the more values go up. That's it. That's how simple it is for values to go up. The more, if you don't have a beast of a city that is increasing wages going up, then how are you going to get this mix of the more you earn? It's come off such a low base. So people are like, it's made 30% in 12 months. It's like, but it made nothing for it. Just, you have to look at the bigger picture.
I always talk about on like strategy calls about the diversity of the economy, because like I can say Townsville's going to grow really well, but if I've got the choice between Brisbane and Townsville, Townsville's got like 4 industries. It's got like military, mining, hospitality, tourism. That's it.
Yeah.
If one of those industries die, if the government changes the military and they move it to Mackay, completely different industry there. It's not going to have capital growth. Whereas Brisbane's got its 10 major industries. So it's risk adverse as well. For the long term, you're actually banking on pretty much better capital growth for the next 10 years.
It's exactly what happened to Rockhampton. Yeah. Rockhampton, I remember doing depreciation schedules there at my old firm. They were like coming in, like it's like dodging them. And then all of a sudden I was like, I haven't done anything in Rocky for ages. And then you'd find out, and then I always love seeing where people buy, and things like that. And I'm like, this is a good little investor, $600,000 property. Yeah, it's pretty good. And then all of a sudden you'd see 1 or 2 trickle in, and you're like, 385, is that right? And then you'd see such a huge drop and you figure out what's happened. And when the bottom end of that economy falls out, so does everything else.
I still blame buyers agents for this, because they just be like, you can't afford Brisbane, let's go Mackay, let's go Rockhampton. And they move there for affordability, and their whole selling point is affordability. They're not talking about what you're talking about of like, why is affordable good or bad? It's the backing of the industry. Affordable means no one wants to buy there. That's why it's affordable. But again, there's also a data affordability of looking at medium household income versus medium house prices. They're not talking about that. They're talking about, if I'm in Sydney, can I afford that? That's not investing.
Yeah, and usually investors, there's no scarcity. Like if I would invest in an area that is predominantly owner occupied, because then there's just, without getting into too much, and the same as commercial, you want to go in an area that is established. It's not like an up and coming area. This is a fault of the councils when they build apartment blocks, and then they have to have a certain amount of retail space underneath. It's in the wrong spot. It's not in the right, but it has to get the building approved. You need to have a mix of retail and residential. And I just think, oh God, I would never. I always think, who buys these places?
We've had a lot of good outcomes for clients that we bought 3 years ago in like Sunshine Coast and Burleigh Heads and that, because we found it really hard to get in the market because the owner occupiers were just snapping everything up. And we're like, this is a good sign. Let's get in.
That's it.
Now we can barely get in at a 5 cap rate, whereas we're buying at 6.3, 6.4 3 years ago. So all those have a really good time, but we're not buying that many anymore because it's really tough, because the investors just pay a premium for it. The owner occupiers pay a premium.
Yeah. So when you have that appeal on both ends, you do have additional competition. And you got to remember, it's just a transaction between a willing buyer and a willing seller. And if you've got more willing buyers, then the willing seller's prepared to go up. So, with commercial, if you do have that double-ended demand.
We get all the time people say, oh, don't buy in the $1 million price point for commercial. There's too much competition. And I'm like, don't we want that? Like if I'm putting my house to auction, I want 50 people through the door. I don't want one. So isn't that a good sign? But they're trying to premise it of like, are you going to pay too much for it? Which you might be, but that's where you look at the cycle and what the driving factors are.
Always think, if I'm attracted to the property now, chances are 10 years down the track, the same features will also be attractive, versus like it doesn't have good foot traffic, or it's like, say you have a great tenant. If that tenant left, could you easily replace that tenant? Just got to be really careful, because yes, you got a dentist in there, and yes, he's doing fantastic, and yes, it's like, anchor tenant. If they leave, it's like,
we get that all the time with people that like, oh, I found a medical specialist in an office suite, and they're like third floor in an office building. I'm like, we're going to pay a huge premium for that. If they leave, we've now got a 17% vacancy rate on office space, and the 5% cap rate will jump to like a 7%. We're going to lose a lot of money. They just see like, oh, secure tenant, but it's not always the case.
Yeah, you can get lucky. They could stay there forever in perpetuity, right? Pass it on to their son and their grandkids. But that's
in general. But the point you said, we always buy stuff with a land component, because you've got infinite sky space and you can't control the scarcity with that. But if we buy a warehouse in a well encapsulated residential area, no more land to be released. If the population's growing, so it grows 30% in the next 10 years, why is a warehouse going to be in less demand? Like you're still going to need that space. You still need car mechanics, wholesalers, fabricators, distributors, storage. Like you've still got all that.
Oh, this is good. This is good.
Awesome. Well, I know we've kind of poo-pooed hotspots and locations and stuff like that in this podcast, but I didn't want to let you leave without possibly getting your opinion on maybe spots you like. So maybe we can call this like segment like spots or something like that, where, you obviously see a lot of valuations.
You're putting me on the spot. Okay, let's go.
Just tell us some, some locations, maybe anywhere that you think are going to be growing capital value. And we'll premise this for residential.
We'll go
residential.
I think because commercial's a bit, that's
what I was going to say. So you don't do too many commercial valuations. So I thought residential might be the best way we can have a look at this. Just on your opinion.
In Sydney?
Anywhere you want, anywhere you like.
Right,
you say
Sydney.
You see movement. Maybe you're seeing movement, like markets going up. Or
I always for residential, I'll give you the formula. Okay. I say this to my clients, so you're getting this for free. Lucky you. You always need an A, B, and C grade suburb. Okay. And
in your portfolio?
No. When you're buying it, you always got to make sure there's an A grade to your suburb, and you got to make sure that there's a C grade to you. So you're buying a B grade. Okay, I'll give you an example. Let's go with Randwick. Everyone knows Randwick. Now, Randwick is an A grade suburb to like maybe Kingsford, Kensington. Yeah, so people that live in Kingsford and Kensington want to eventually they'd like to go into Randwick, and then those in Randwick will love to break into like the beaches of like Coogee or Bronte or something like that, which means that as the top end increases and your Brontes and your Clavellis just keep getting more and more expensive, imagine a cup of water, you got the funds trickling down into Randwick, because it's the B grade to your A grade. So as values go up, the money just trickles down. But on the other end, you have people that are in Kingsford and Kensington, I'm just using them as examples, that maybe they're earning more, or they, two couples got together, combined incomes, they sold a property, they've got some money. You know what? I like it here, but I've always liked to get into Randwick. Let's take our money up. And so you're getting a cup of water on the bottom, and you're filling up the Randwick cup on both ends. Now, if you have that push-pull dynamic happening, that value will always go up. Okay, so my advice to you is, whether you're going to Sydney, Melbourne, Brisbane, anywhere, you find an area that has a very strong push-pull on that B on that A and C grade to your B grade suburb.
I'm stealing that.
That's
I like
interesting.
That. Yeah.
I never heard that.
Yeah.
I've noticed that actually on the northern beaches. We're kind of being periphery looking around for principal residents. So like I'm in freshwater. Even on like a micro scale, we see like the beachfront sell for 7 to 10 mil.
Yes.
Then you go a few streets back and they're 5-6 mil. Then you go a couple blocks inland, they're 4-5 mil.
Yes.
Then 3-4 blocks in, they're kind of 3-4 mil.
That's the money trickles,
That's
right?
it. You see the money trickle. But then there's also an argument that if you go too far and you're not walking distance to the beach anymore, so you lose the whole perception of being in that area. And that middle area, I looked in the last 10 years, outgrown the beachfront ones.
Yeah. It always comes down to a willing buyer and a willing seller. And it always comes back down. This is with residential. I've written a few articles and sound like I've written articles, but I think the way my brain works, like I just always see that people see valuers. I think this is what they miss. Valuers, they see the numbers, facts and figures. They just so caught up on the numbers where I always like to start at like A, even before A, like what happens before we get to A. And that is, they are human beings. We are human beings that want to pay something for a property. So what is who are the people that would want to buy that property and pay? And why are they capping out at 17 mil? Why aren't they going to 23? Because we know they can get to 23. Plenty of homes in the east are selling for 23. Plenty of homes are selling to 30, 40 million. Why are they stopping at 17? What stops them from? And if you can understand the human being behavior and why they stop there, then you'll understand why they stop at certain areas and where that money trickles. And it comes down to people earning, borrowing and spending and what value they put on that. So instead of looking at how markets are moving, look how the human beings are behaving. Go to auctions, see if they're bidding, see if there's a lot of people turning up to opens. Where are the human beings going and where are they and how are they?
I think you've explained the ripple effect in a much clearer way, because most people just think expensive houses. People can't afford that. Let's go to the cheaper one. Let's go to the cheaper one. But it's right. It's the push-pull between people upgrading and people downgrading.
Yeah, and it's always, everyone has a B to the A grade suburb. Everyone's got their dream suburb and they start looking and they're like, it's more expensive than I thought. I'm going to take my money down. And you got to then also go, okay, if I'm trying to get top dollar for my property, what are they missing out in going back to Randwick? What home, if sometimes they're like a little bit snobby, certain people, okay, not the East maybe, but they're like, I wouldn't never be good dad in Randwick. Oh my God. But if I have to live in Randwick, I need to have this type of home, right? Yeah. So their home could be the same price as a Bronte home, but they're getting a hell of a lot better property than Bronte. So it's like a compromise. Actually, I don't know if you could put this. Robert told me this one, and I use it all the time. So that's why I don't mind if you take the AB push pull.
Robert works for us guys in Palise Property. If you want to have a chat with him,
Robert, this one's for you. He said it, and I've used this a couple times. He's like, Sydney has three. Let's play the Sydney game. You got 3 scenarios, which is your dream house, your dream location, your dream budget. Pick 2. Okay. That's Sydney. Yeah. You want your dream home and your dream location, you got to compromise on the budget. Yeah. You want your budget and you want your home, you got to compromise on the location. Yeah. Yeah. So very few of us can have all 3, but because it's so expensive. Sometimes I get clients and they're like immigrants, like they've come from Brazil or India, and I'm like, why Sydney? Like, why? You know, like you've come here and you've tried so hard to make a life for yourself and you're earning good money. I'm like, you can't. It's hard. And I joke. I'm like, you could have gone to Tasmania.
There's something in the human psyche about pushing it as well, because it's like I said, I'm on Northern Beaches. I could move 3 streets back and have a very comfortable mortgage, but there's something about, if I spend an extra mil, I can then go for a swim every morning because I'm 200 meters from the beach. Yeah. Then you're like, if I spend another 2 mil, I can see the ocean, and you just go into this weird, never-ending cycle.
Well, I sold 2 investment properties to build my home because I wanted a nice home for my family. I could have easily stayed where I wanted, and you know what I mean? So it's, that's Sydney. It's the compromise we make. Yeah. And I think for some people, sometimes we don't put in, we get caught up in the building portfolios and money, and I think, it's your own happiness, because again, your happiness as a human, that sometimes you can't put a dollar figure on, and who cares if you own 100 property portfolio, you know what I mean?
Yeah. Our slogan for Palise Property is invest in happiness.
100%. Yeah. So that went deep. Yeah.
Tell me about your childhood trauma.
That's really awesome. I haven't heard that theory before. So
I'm literally stealing it.
If you don't already have a name for that, I think you should call it triangle investment theory, something like that, like coin like that.
Go the Botsolus theory or something like that.
Come on. But anything else that we want to touch on, Steve? Any other questions,
this.
or we pretty much?
No. I love this session. It was great.
Yeah, awesome. I had a whole list of 20 questions. We didn't touch any of them.
I knew it was going to go.
Actually, my screen's black. Didn't touch any of them. So this has been fantastic.
When I heard you guys can talk underwater, I was like, hold my beer. Hold my beer.
Awesome. So I just want to give the other listeners an opportunity to go and connect with you. Where can the listener go to reach you?
So this is super original. If you go on any platform, honestly, like TikTok, Instagram, Facebook, whatever, and you just literally type in like The Valuer, Belinda the Valuer, anything to do with Valuer and Belinda, I pop up.
Yeah. Literally follow her accounts.
Surprise!
You're similar to us. Like you give heaps of education away for free. So follow her, guys.
Yeah, I started. The only reason I'm sitting here today is because I just found so much misinformation online. I just wanted to give out as much. I didn't care. I'm not gatekeeping. I gave you my secret, like pouring the cup into the water. I don't care.
Yeah. Triangle
whatever.
theory.
Who cares? I don't. Yeah, you get me a whole course for free. Whatever, right? So it's just it's karma. It's putting it out and just if you do anything and you take anything away from today, just get good quality advice. That's it.
And which platform are you most active on? Is it Instagram?
I'd say Instagram. Instagram and TikTok.
Are you TikTok?
Yeah.
Awesome. Any dancing?
No. But you sound like my mum. You're not dancing, are you? I was like, so what if I am, Mum? It's like it's OnlyFans, relax. No.
I had a client last week being like, I saw your TikTok. And I'm like, I'm on TikTok? And my social media team obviously put me on TikTok.
Yeah. No, it's I was doing TikTok when TikTok wasn't like cool.
Yeah.
As I just had the value. I didn't have my name, who I work for.
Yeah.
So my boss pulled me in and he's like, are you on that app?
Yeah.
I was like, don't fire me, please. So yeah, I just, I think it's about getting out there and sharing what you know.
So type in Belinda the Valuer.
That's it. Yeah, Belinda Botsolus, Belinda the Valuer, Belinda from Bankstown.
We'll put the handles in there in the comments.
It's so funny. I didn't live there for long, but it's honestly, I love making fun of it. It's good.
We're filming today in Parramatta, and like Northern Beaches, it's all big white four-wheel drives.
Yeah.
Come out here and there's all the exhaust going off. I'm like, I'm home. I can smell the fuel.
Yes, well, I just not like I moved anywhere so far because I went to Brighton Le Sands and that they've all seemed to come there on the weekends. Yeah. I'm like, my people, they're here. From the hood.
Awesome.
Represent.
Well, this has been Belinda Botsolus, Steve Palise, and Andrew Bean on the Commercial Property Investing Explained series. Thanks, guys.
Thank you.
Thanks so much, Belinda. That was awesome.